I think it was last week we heard that a number of ETFs, silver ETFs in India, suspended share creation because they couldn't source the silver. And I think on that basis, really what we see is that silver is too cheap for these deteriorating monetary conditions. That is absolutely clear. It is therefore going higher. But the question is, you have to ask yourself, as the price rises, what are people going to do? Are they going to just take profits? Or are they going to say, I'm going to hang on to my silver because things are not looking so good for the fiat currencies, for the dollar, whatever. Gold is going up. Gold-silver ratio currently 84, should be below that. Why should I sell my silver?
Silver had entered into backwardation in early October amid very short supplies of the metal in London, driving prices there significantly above those seen in New York. This supply squeeze was a major catalyst for silver to break out to an all-time high above 45-year resistance at $50. This silver Magino line of resistance was destined to be a battlefield, as the metal reached a price area where paper traders test conviction, producers hedge future output, and nervous longs lock in profits. The London Bullion Market Association faces unprecedented pressure as silver inventories reach critically low levels, creating what many analysts describe as the most severe physical metal shortage in decades. The silver shortage at LBMA represents a fundamental shift in precious metals markets, where traditional supply mechanisms appear unable to meet surging global demand. Alasdair Macleod warns that the silver market is facing an intense physical squeeze, with lease rates soaring up to 100%. Most silver in LBMA vaults is locked in ETFs, leaving little freely available metal. Several ETFs, including those in India, have even halted share creation due to shortages. Macleod adds that silver is now too cheap for current monetary conditions. Rising silver prices can paradoxically increase demand rather than reduce it. Higher prices attract more buyers rather than fewer, completely inverting normal supply and demand relationships. In his outlook, Macleod cautions that silver ETF holders, such as SLV or PSLV, don't truly own physical metal, but only a credit claim that could be rehypothecated in a crisis. He urges investors to hold physical bullion directly or store it in secure jurisdictions such as the UK, Switzerland, or Canada, warning that relying on paper assets could be dangerous if the global credit system collapses. Before we dive into Alasdair Macleod's sharp insights from their latest interview, make sure to hit that subscribe button and tap the bell icon so you never miss a moment when truth meets the market. Let's get into it.
There's no doubt there's been a huge great squeeze. You can see this in lease rates, and basically, someone who's got an obligation to deliver physical metal tomorrow, and if he hasn't got it, he's got to go and lease it from somewhere. So, the lease rates have shot up. Typically they were sort of up to 30-40%, and there's some reports of them going up to 100% and more, basically saying, there's no more left to lease. And the other thing, of course, is that we see a backwardation, which by definition is when the spot price is above the futures price. And people got very excited with that being over $3 at one stage, which, of course, would prompt arbitrage. People with silver sitting in COMEX warehouses would think, okay, we'll ship some of that over and make on the arbitrage. So there've been lots of stories about that. Now, how true they are or whatever, I honestly don't know. I'm sure there's a bit of it, but it's probably exaggerated. What I would say is that the backwardation of spot over futures has actually declined now to around about $1. So it's come way, way down. It still indicates that there is a shortage. In other words, a squeeze on those who are short. Because the problem is that the vast majority of the silver in the LBMA vaults is ETF silver. And the other thing which puts additional pressure on the system is, of course, people look at silver, they see silver going up, they probably think they've missed gold, and therefore the silver is a cheap way in. So they run out and buy ETFs. ETFs have to source the metal. And I think it was last week we heard that a number of ETFs, silver ETFs in India, suspended share creation because they couldn't source the silver. And I think on that basis, really what we see is that silver is too cheap for these deteriorating monetary conditions. That is absolutely clear. It is therefore going higher. But the question is, you have to ask yourself, I mean, as the price rises, what are people going to do? Are they going to just take profits? Or are they going to say, I'm going to hang on to my silver because things are not looking so good for the fiat currencies, for the dollar, whatever. Gold is going up. Gold-silver ratio currently 84, should be below that. Why should I sell my silver? So I think it's a situation which actually, particularly through the growth of ETFs, a rising price could lead to further demand and less supply, because the supply always has been from weak holders in the paper markets. So I think, Jesse, this is a fascinating situation. It's what they call a Giffen good, something which reverses the normal supply and demand relationships on price. I think what you have to do, when it comes to where you store your metal, and whether it's Canadian Royal Mint or whatever, is to take a view on the property rights of that country. How firm are they? Are they likely to be overturned, if you like? Now, I mean, it's an interesting point. I've had arguments with people about what happened in 1933 when, you had the executive order and basically it wasn't a gold confiscation. People say it was a gold confiscation. No, it wasn't. It was a forced submission, if you like, of your dollars for gold at that time at $20.67 to the ounce. So, if you actually had gold and it was the banks, basically, if you had it in the banks obeyed the government. So, you lost it. On the other hand, if you had it yourself, then you just kept quiet. But it was really when it goes in the system. And if they turn around and do something like that, then you're going to lose it. The difference today is that you have, in America, there is an official gold exchange rate at $42.22 to the ounce. Now, you have to ask yourself the question, would the Americans force the banks to exchange, to take your gold and gold under in their custody and all the rest of it, and exchange it for $42.22 to the ounce when the market price is $4,100 or even more? I don't know the answer to that question. There may be a legal way in which they could do it. So what I would say is you don't store your gold in America and you don't store it in a vault owned by an American corporation. And that can be in a vault abroad. So I'd say that. I think the Royal Canadian Mint, I would be less worried about because Canada has some very strong property laws when it comes to property rights. I feel the same in the UK. The same is true in Switzerland. I think the other thing is that there is a big difference between banks who are regulated, and they may well be, the regulator, through regulation, if you like, there may be a bit of a danger there. But I think by far the biggest danger with ETFs is that actually, when you own shares or stock in an ETF, it's credit. You do not possess the metal. You do not even have an entitlement to the metal. All you have is an obligation by the manager of the ETF to perform his duties on behalf of you as a shareholder. He's got the obligation and you've got the credit, if you like, the other side of that obligation. But then it gets more complicated because you don't have a direct relationship usually with the manager of an ETF. The manager of the ETF sees as his shareholder either the DTCC or Euroclear, one of those big things. And then it's Euroclear or the DTCC, which has the obligation to you. Now, what this means is that in a financial meltdown, when the DTCC or Euroclear or something similar is, if you like, in the middle of failing counterparties, they are perfectly entitled by law to take what you think is yours, shares in an ETF, and deploy it as collateral or even dispose of them, bearing in mind that it's still got the obligation to you, because it'll just say, oh, don't worry, we've got an obligation to provide it, but meanwhile we're using them, thank you very much. Are you going to be like, do you like that? No, I don't think you would. So bear these things in mind. This is the difference between owning ETFs and actually owning the physical metal, either in your possession or in the possession of, or being stored in a vault, clearly your property, in a jurisdiction with strong property rights.
Macleod notes that mining stocks are a leveraged bet on gold, benefiting when prices rise but sensitive to energy costs and production management. He warns that in a credit bubble burst, investors may sell miners to cover losses, stressing that physical gold should remain the core holding since it carries no counterparty risk. Gold miners are on track to deliver stellar third-quarter earnings, fueled by a record rally in bullion prices, as investors await updates on recent CEO changes at top producers Newmont and Barrick. Analysts expect the two miners to post a combined profit of nearly $3 billion for the period, more than double last year's $1.4 billion, according to data compiled by LSEG. Following post-COVID debt excess, Macleod warns that the U.S. economy has become zombified, burdened by unproductive borrowing and high rates. He cautions that persistent tightening will trigger business failures and, ultimately, a collapsing dollar, driving gold sharply higher with each Fed rate cut. Despite the recent volatility, the fundamental backdrop for gold remains supportive. The prolonged United States government shutdown and persistent geopolitical and economic uncertainties continue to drive safe haven demand for the yellow metal. Let's get back to the interview.
Basically, mines are a leveraged bet on the commodities that they produce. And if you see the value of gold expressed in fiat currencies rising, so long as energy prices don't rise more quickly, that's going to be good for mines. I mean, you've got to look at the input cost side as well. And also bear in mind that most producing mines, they will be managed through this. So what that means is that they will extract lower grades while they are profitable, rather than the higher grades. So the idea that you can translate immediately a higher gold price into higher profits, I think you've got to temper it a little bit and just understand the reality of it. The other thing I would say is that gold is hardly owned. It's less than 0.5% of portfolios, if you like. Mines, on the other hand, I think are a bit more owned. And what I'm looking at is this is a credit bubble. Obviously, if you've got a debt bubble, which we have, the other side of that is credit. And more importantly, this credit has been applied to inflating financial assets, particularly stocks. Now, all credit bubbles come to an end. They pop, and when they burst, they usually burst quite spectacularly. 1929, October. 1987, October. October doesn't seem to be a very good month. I'm not saying that this October is going to be the crash, because, we'll look back on it and see whether that's true or not. But, when the bubble implodes, basically what people do is they will sell anything where they've got a profit in order to cover the things where they've got a loss. So that's the only caveat I would really have, I think, on investing in mines. But other than that, it's you can regard it, if you know what you're doing, as a leveraged bet on the underlying commodity. In the case of gold mines, it could be a way of you catching up if you want to speculate a bit as to, the route to do it. But your core holding always must be the metal, because that is the one thing where there is no counterparty risk. The fact of the matter is that there was an explosion of borrowing, debt in other words, when interest rates were suppressed at the time of COVID. You had businesses who were forced to stop trading and needed to finance themselves so they could resume trading once COVID was done. And as well as governments, you look at governments, the government debt in the US doubled between the end of 2019 and today. I think it was 23.6 trillion at the end of 2019, which was literally just before the COVID thing started, which I think was 23rd of March or something, 2020. And today we're looking at 47.4 trillion of government debt. So you've got all this debt, and it was all taken out when interest rates were suppressed, when the Fed was going in there doing QE and suppressing yields along the yield curve. So everyone's got all this unproductive debt, and it's basically turned a large portion of the US economy into zombies. And the US government itself, if it couldn't rely on printing money, as it were, is also a zombie. But, so I really do think that there's a time factor here. The longer that we have current interest rates, even if they just stabilize them, the longer we have them stabilized, then what you're going to get businesses falling over. And I think the car loans thing is a classic case, because that's just an agglomeration of debts, everything from good to doubtful to bad. And the idea is it was the old syndication. Do you remember the property syndication business we had in 2006 to 2008? okay, there are liar loans in there, but who cares? We can slice and dice this so that the top quality, which we'll sell off to the pension funds, will be AAA. It's the same arithmetic, if you like. You just get a huge, great portfolio of all these car loans, and you can give them a rating which actually is far higher than it really deserves. Car loans. I think also the Main Street, as opposed to Wall Street, is not doing at all well. I mean, it really is not. So you're finding that people, they just cannot afford to pay these higher levels of interest, higher debt rates, and all the rest. Higher interest rates. They're not, they're losing their jobs. They're not getting the pay rises. Whatever. I mean, I don't care about job statistics. I mean, they're all wrong anyway. But you can see the underlying economy is actually deteriorating, and even though a lot of government statistics have been shut down because of the debt ceiling, I really do think that there are other indicators which show that the economy is just not good. And under those circumstances, you're going to see more failures. It's quite simple. Eventually, the big failure will be the US government. But that's reflected in a loss of purchasing power for the currency, which is why you have gold, and which is why when the Fed reduced interest rates a month or two ago, gold took off. And if they reduce it again, gold will take off again. And if they reduce it again, gold will take off again. I mean, because what's the Fed doing? Doesn't care about inflation too much anymore. The priority is to try and keep the economy going, keep the job numbers up.
The substantial basis differential between spot and futures contracts has created theoretical arbitrage opportunities exceeding $3 per ounce. However, these opportunities require the ability to source, transport, and deliver physical metal, capabilities limited to well-capitalized market participants with established supply chains. The silver market bulls have the overall near-term technical advantage, but stiff resistance levels lie above the market. Do you believe the coming financial reset will finally expose the limits of paper assets, or will central banks once again manage to kick the can down the road? Drop your thoughts in the comment section below. If you find this video informative, don't forget to support our channel and turn on notifications to stay informed about our latest videos. See you in the following video.